I think. Yeah, trying to find the interest rate. In this case, it equals the cost of debt on this bond. Another way is also similar to IRR on the bond, but I don't think we've done that either. Okay. So, what they've done is that I've said that they said to me, okay, this asset is going to be worth 1,000 at the end, and we're going to, you've given me 100,000 rand, and we're going to give you 10% on that. Okay. Now that 10% interest is it's often paid out in 2 semi-annual coupons. So what I'm going to do is I'm going to just split the screen here. And I'll call these inputs. This is what you're going to punch into your calculator. And what we're basically saying is, they've said to me, okay, the end value is 1,000, we're going to give you 10%, but we're going to pay you semi-annually. So the coupon that they're actually going to pay us is 50 rand. Okay, that's the 100 rand divided by 2. And the 100 is equal to the 1,000 times 10%. Okay? What they said is, they said to me, okay, well, 10 years, but the number of payments I'm going to give you is actually going to be 20 because I'm paying you every 6 months. So N, and these are, the coupon is equal to, on your calculator, you'll see the term PMT, and N is equal to 20. Okay, now the future value, is 1,000. And they've said that the current value, so what we call the present value, is equal to 892 spot 50. Okay, so what we're trying to do now is they've given us, these are all the inputs you need in order to solve for what we're going to call the cost of debt. So it's otherwise the interest rate in your calculator. When you're doing this, the one thing you must be careful of is when you're punching into your calculator is, you can do it either way. You can either make these two negative and leave that positive when you enter it into your calculator, or the other way around. So just leave these positive and make the price, the current price, negative. And it's a time value thing. You just need to have one of them, especially the present value or the future value of the payment, negative, so that your calculator can solve for the unknown. Okay? So let's just punch that in. Sorry, this is a made-up example. Okay, so we've got payment 50, enter, future value is 1,000, enter, present value is 892, spot 5, negative, enter, N is 20, enter. Okay, we solve for interest rate. What I do is I get 5,932. Just remember, we've done this on the basis that it's semi-annual. So what I need to do is I need to times that by 2. I get 11,86%. That is my cost of debt. Nice and simple. Okay, so in our exam they didn't specify whether the bond was semi-annual or not. So if it wasn't, okay, so if it was just an annual bond, very simply what would have happened is your payment would have been 100, N would have been 10, future value would have still been 1,000, present value would have still been 892, it's about 50. And that's how you recalculate. You will get a slightly different answer. Let me just quickly do it for you. 10. So I get 11,89. Slight difference. What you must do is if they don't give you one, basically make an assumption and say, you can use either one. Say that the the payment of the coupon term hasn't been given to me, so I'm assuming semi-annual because it's quite often that government bonds pay their bonds semi-annually. Otherwise, you could just say, I've assumed it annually because the time frame wasn't given, and I've assumed that you can, that they will pay us annually. A lot less likely, but easier to calculate. Great. So that's one. Sorry, I need to just do one more thing before we move on. What they may do is they may say, instead of giving you a common price, they may say that the bond is trading currently at 80% of par. If you know that par is 1,000, what that means is that your current price is about 800. So again, just spend a little time reading through. Actually, looking at the midterm test that we did is also quite useful. But just lay it out logically. You should get marks for your inputs. So just try and think, what debt have they given me, and how do I then calculate the cost of it? This is probably the hardest thing that you need to do, is the bond calculation. But there could also be bank debt. Okay? And another thing they could do is just say, well, they could say, well, your debt is, government debt is, say, 8%. And you see it on there. Is that okay? Government debt's 8%, and your debt is expected to carry a risk premium of 1.5%. And this is just the spread. Basically saying I'm taking the default, an asset that I know the risk of, and I also know that how much greater my risk is, and you just add them together and you get 950. So that's the third way. It's just it's called a spread approach. But highly likely that you could get one, if not a combination of them. What you must do is work it out logically. Once you get 3 answers, so I know, say I get 11,89. Here, let's just say I had 10%. It's definitely not that. And here I got 950. What I then need to just simply do is to calculate my cost of debt. I need to take the weightings. If I knew that I had 20% in here, and I had, well, just weight it. I mean, it should be logical when I say that, but let's just say if I had 20% times 950 plus 40%, representing 10%, plus another 40%, representing 1189. What that would then lead me into is one figure, which is my cost of debt, and that is the input that I can go back into my WACC. Again, we've taken the various sources of debt, we've weighted them, and we've come up with a cost of debt. That's what we'll use. I know that may seem long-winded, but I hope it's clear. The exciting stuff is the cost of debt is what we've just calculated. One thing you need to know, the cost of debt, is you also have an interest tax shield on it. You're just going to times by 1 minus, it must be an after-tax cost of debt that you use in your WACC. You go into more debt later, of course, why? But for now, just be wary of, look out for a tax rate. If they don't give you a tax rate, what you can do is you go to if they give you an income statement, you can look at the tax they've paid, divided by the income. It'll just give you an approximate rate. So if they give you a tax rate, great. This is nice and easy. You can just add it in here, times it by the cost of debt you calculated. If they don't give you a tax rate, don't worry. Either make an assumption that's reasonable, or go to the income statement, see what tax they actually paid, and you can calculate it that way. Right, moving on. Our preference shares are easy. We're going to do them now. Let's just leave these till we do an example. Sure. So, I mean, maybe let me just spend 5 minutes just going through the slides and explain what we've kind of done. I've got a gizmo here. Okay, so we started off just looking at the WACC and how to calculate it. And we've taken down each of the, we explained what it is, and we've taken on each of the components and started to understand, well, how do you calculate the return on equity? We've said there's two ways. You can use the dividend discount model, which is, there's two different methods here. And then you can also use a capital asset pricing model. Largely dependent on the information they give you. And the risk-free rate that we've mentioned, just remember to watch out for the term that you're trying to calculate. And they may give you a bunch of bond rates. So when you see bond rates, immediately start thinking, okay, that's one of the components of my CAPM. It's not a component of the dividend discount model. Initially, I'd say that there are differences between the dividend discount model and the CAPM. Maybe just to highlight a few now that we can see it in the same sheet. This model relies on a growth estimate, and it's very sensitive to changes in the growth. So if I'm plugging in assumptions, this could fluctuate a hell of a lot just because I'm changing my growth. You'll notice in the capital asset pricing model there isn't a growth estimate. But also you have a beta that you need to calculate here, which is great because it measures risk. You know, if I look at the top one, like, you may try and say, well, I assume that my price incorporates the risk, but there's no actual measure of the risk per se in the top method. And then, yeah, so the inputs for the CAPM, as we said, may be more difficult to calculate. But it's quite likely you could get either of these options, so understand both. We then spoke a little bit about CAPM, how do you calculate CAPM, the risk-free. Yeah, we spoke about this. We didn't mention a zero coupon bond. Now, this is similar to what they do with the zero coupon bond. And if you get one in the exam, just think of it like a bond. So think I've got a bond, but I'm not going to get payments. I'm giving the government my money, and what they said is basically we're going to roll it up, and we've rolled it up into the price. So in other words, you've bought it at a cheaper price, and the interest is already included. So all of the coupon payments are built into that price. So you're not going to receive a 6 monthly coupon. So if you're doing it, just look here. So if we're looking here, if they give you a zero coupon bond, you won't have a payment. It becomes very simple in that you have a price and a future value and a term. And then all you're trying to do is solve for your interest rate. So the payment then just becomes zero. So don't be confused by it. Okay, so we've spoken a little about this. Yeah, let's just, when we spoke about CAPM, I'm just going to go back here quickly. Another trick and something to learn is to calculate the mean, so the expected return or the average return of the market over time. They can either use what they call an arithmetic mean, or they can use a geometric mean. And you know, it does talk about it here, but in short, you want to use the geometric mean if it's more than 10 years. And less than 10 years, you can probably use the arithmetic mean, but any longer and you're starting to skew your results. And it can be quite dependent on the flow of your returns, but as a rule, you may want to justify why, because the geometric mean builds on the time value effects. And in reality, you tend to use geometric mean a lot more outside of our school. Okay, we spoke a little bit about, this is the term structure of, well, we didn't speak about the term structure, we spoke about bonds, and we spoke about the purpose of how bonds tie into what we're doing. Okay, how bonds tie into what we're doing. And basically we've got, you can leave it there, we've got, this is just explaining how the relationship with the yield curve works. Don't get too sidetracked with this. It is nice to know, and it is quite important if you're looking at bonds. But for the purpose of what you're doing, the big picture you've got to remember is that we are trying to calculate the weighted average cost. Okay? And if they give you a bond, the chance you may just need to calculate the cost of the bond. Can I fix it a little bit so it does? So it gets the whole slide in. Cheers. Measuring the risk premium. Yeah, they may give you it again. Some of the information they give you, others you need to calculate. That's what I was saying earlier, just about the arithmetic versus geometric. For shorter time frames, you want to use the arithmetic, and for longer time frames, just use geometric. Great. Okay, so they give you another ways to calculate the risk premium. You can have a little reader. You know, the ways I've spoken about, I've tried to just give you a big picture. You may want to dive into a little bit more detail, but because this kind of question will generally have a lot of factors that you need to work into a final figure, you've also got to go one step at a time. Okay, we've spoken about using the yield to maturity. And that's to calculate on the bond the cost of debt. And bond ratings, it's just you have different risks for different ratings. Okay, let's just quickly do this. Quite simply, if we go back to one of the final inputs we've got in that WACC that we need is the cost of the preference shares. And it's quite simple. See, and they give you the formula is actually given here, I think, so I'm not even going to speak about it too much. Preferred dividend per share over the market price per share, that will give you the return. So, I mean, it's quite simple. You can just use this formula. So it's pref div per share over the market price. Okay. What we've done is we've actually now covered most of the inputs that we need in order to calculate the cost of capital. I do have a few minutes, and I think what may be nice is to take you through an example, but this is the midterm exam that we did last year, or the midterm exam we did this year for our course. And I'm just trying to think of enough time to actually go through it. I'm going to start it anyway, and then we can, if we run out of time, then that's okay. Great. So the Stormers have bought a stadium, a new stadium, and they need 100 million to raise 100 million bucks to do it. They've said they're going to try and keep the same capital structure as they're going, and they've also added in some information about flotation costs. Don't be confused; those are just costs associated with each of the sources of finance. Makes it more expensive, and it increases, your WACC. Okay. So how did the flotation costs impact the decision to build a new stadium? Well, they make, as I said, make everything more expensive. There's a little article in your book that you can read. It again, guys, it's quite simple. You just look it up and go and have a little read. But let's look at how we determine how we go about thinking about the cost of capital. I did all right in this exam, and I want to encourage you as well to just think of the big picture when you're doing this. You may not get all the little bits exactly right, but the important thing is trying to at least know where you're going. It's a good start. So, cost of debt. Okay, so we're going to start. We're actually going to need to do the market values first. So let's just look at trying to do the weights. This is the first input for the WACC. Okay, so the weighted debt. We're going to, first we need to calculate the market value. Let's just write like this. Debt, value, market value. Great, so let's just see what they've actually done for us here. So in the example, they give us, and they've given us these two sources of debt. So the book value is 65. Okay. This is the preference, that's the book value, and this is your equity. So quite simply, this is debt, pref, equity. 65, 32, 103. Total comes to 200. So how do we do the market values? Well, let's look at the debt. We're actually got the equity. Let's start with the equity here. So the equity, what they don't give us the current price, but they give us a PE ratio. And the PE ratio equals 15. Okay, and the PE, remember, is equal to price over earnings per share. And what they then say is, well, the earnings per share, we've told you the net profit, which is 20 million. And we've also told you that there's 10 million shares. So the earnings per share is equal to 2. Okay. So what we want to figure out now is, well, what is the price? We know the earnings per share and we know the PE ratio. So P over 2 is equal to 15. Therefore, the price is equal to 30. Okay? And we know there's 10 million shares, so therefore the market value of our equity is equal to 300. Great, done. So what do they say about preference shares? So preference shares, here we go. Preference shares, I said it's an 8% dividend, 100% par. Should sell for 125 rand per share. Okay, fantastic. Yeah. So they said that we got 32 million and it's 100 rand par value. And they're going to sell them for 125 And the debt? Well, what do we know about the debt? They've said that here that the bonds are going to be sold at par value, and the debentures are going to be sold at 80% of par value. So that's the current value, and you can see that the bonds was 40 of the 65 million. So that's going to stay the same. But 80% of 25. So 28 times 25 is 20. So that means the total market value is actually going to be 60. So when I total that all up, what do we get? 400. Great. So then you just work out your percentages. 75%, 10%, 15%. Okay? See, we've now done the, you'll get marks for a lot of this along the way, but we've actually calculated the weights that we've got here. Fantastic. So now if we quickly do the cost of debt, I'll give you time. Running out of time. Okay, so the cost of debt, what have they given us? So they've given us a debenture and a bond. So what we need to do is let's look at how I'd approach that. They've given me enough information that I think it would be best to try and calculate the yield to maturity on a bond as opposed to doing any of the other methods. The other methods being adding a spread to like government bond or just the value of bank debt. So what do they say on the bond? They said that there's 8.5% interest. It's 20 years to maturity. And they're going to be sold at par, which is mean 1,000 is going to be equal to the future value. 1,000 is equal to the present value. So what are their inputs? Let's go to our inputs here. Okay, so 8.5. What I've made the assumption is, semi-annual payments. Therefore, the 8.5 times my 1,000, 8.5% times the 1,000 is 85, divided by 2 is 42.5 is my payment, otherwise known as the coupon. 20 years to maturity, and we're doing it semi-annually, so therefore N will equal 40. Future value is 1,000, present value is 1,000. Therefore, what does my interest rate? Solve that. Okay? So let's just quickly punch that in. 42.5 payment. 40N, 1,000 future value, and 1,000 present value negative. We get 4.25. Which equals 8.5 times by 2. Notice that when a bond is trading at its current, at its par value, that the yield to maturity equals the interest rate on the bond. Just something to notice. Okay, then so this is for the bond inputs. Now we also had a debenture. So the debenture, they said it was 7% interest, 20 years. And then they said that it's 20 years. 1,000, but it's trading at 80% of par. So PV equals that. Okay, so that's the current present value is 80. So let's look at the inputs. Because we're doing it semi-annually again. I would normally get 7% times 1,000 as my par value would be the coupon. That's going to be 35 Rand period. They're going to be semi-annual, so the N equals 40, so this is payment. And future value is equal to 1,000, but my present value is equal to 800, 80% of par. So what I get when I solve for that, okay, 4.6029 times 2 equals, I get 9.21%. Okay, so there are my two costs of debt. Cost of debt of the bond and cost of debt of the debenture. And then what I do is I basically just weighted this. So I found out the value, the total value of here, and it comes to, let me see, I've got it all on. Do you have some of the answers written down? We're running out of time, so what I'm going to quickly do is just explain how I got the cost of equity. They give you values in the example.